Over the last 30 days, gold dropped nearly 9%, silver crashed more than 26%, and one of the world's largest private credit funds just lost almost 20% of its value in a single quarter. These are not random events, they are connected. And today, you're going to understand exactly how, because what's unfolding right now isn't just another market pullback, it's a warning signal. In this video, we'll cover three critical things. First, the real confiscation risk to gold and silver, and why it's not what most people think. Second, the rapidly growing private credit crisis, massive bank exposure, and how derivatives could trigger a domino effect across the financial system. And third, how to position yourself intelligently, including a framework for evaluating mining stocks without guessing or chasing hype. No fear, no FOMO, just clarity. Let's begin. A lot of people are asking, will governments confiscate gold and silver like they did in 1933? That's the wrong question. The 1933 scenario required three things: a gold-backed currency, centralized storage, and legal authority for forced seizure. None of those exist today. Back then, gold was stored in banks. Today, metals are spread across homes, vaults, and jurisdictions worldwide. There is no central registry. Door-to-door confiscation would be a logistical nightmare. And more importantly, governments no longer need your gold to print money. They can create trillions digitally. So outright seizure makes very little sense. That's tier 1, and it's the least likely. The real risk lies in tier 2 and tier 3. Tier 2, stealth confiscation. This doesn't look like confiscation. It looks like taxation. Imagine gold hits $10,000 per ounce, silver hits $250. You sell. Suddenly there's an emergency windfall tax on precious metals. 70% of your gains disappear. No raid, no headlines, just paperwork. Most people don't own metals, so public outrage would be minimal. We've seen this before with oil windfall taxes. It's politically easy, and capital gains taxes on metals already exist. That's tier 2. Tier 3, the end game. This is where things become serious. Central bank digital currencies, CBDCs, programmable money, every transaction tracked, every account monitored, spending limits, expiration dates, instant taxation. You still own your gold, but converting it becomes difficult. You sell your metal, payment goes into a digital wallet, then compliance review, source verification, transaction delays, automatic taxation. You're allowed to own assets, but using them becomes restricted. That's modern financial control, not seizure, access limitation, and this is already being developed globally. Now let's talk about what almost nobody is paying attention to: private credit. This is lending done outside traditional banks, by hedge funds, asset managers, and private firms. It's now a $1 trillion market, opaque, unregulated, no transparency. Here's the issue: these lenders borrow money from banks, then they lend it out. So banks don't directly hold risky loans, but they're exposed through intermediaries. Sound familiar? It's structurally similar to 2008. We're already seeing early cracks. Rising subprime auto defaults, corporate bankruptcies, large private credit funds taking double-digit losses. This isn't the earthquake. These are tremors. And layered on top of this is derivatives exposure, especially credit default swaps. When this unwinds, banks won't absorb the losses alone. Depositors will be involved. We've seen it before. In past crises, governments used bail-ins. That means customer deposits were converted into equity in failing banks. Your savings become stock in a bankrupt institution. Legal frameworks already exist for this. So if private credit collapses, it won't just hit Wall Street. It hits everyone. And historically, when trust in banks breaks, gold and silver surge. Now let's talk strategy. Because in every crisis, there are opportunities. Mining stocks offer leverage to metal prices. When gold rises 10%, a quality miner can rise 30 to 50%. Why? Because mining costs stay relatively fixed. Higher metal prices go straight to profit, but the reverse is also true. So you need a framework. Here it is. 1. All-in sustaining costs, AISC. How much does it cost to produce 1 ounce? Lower is better. The bigger the gap between production cost and metal price, the stronger the margins. 2. Production growth. Is output expanding or declining? Growing production means rising revenue during bull markets. Declining reserves mean melting ice cubes. 3. Jurisdiction. Where's the mine? Stable countries reduce risk. Permits, taxation, and nationalization matter. 4. Balance sheet low debt. Strong cash position. Can the company survive a downturn? 5. Producer versus developer. Producers generate revenue now. Developers are higher risk, but higher potential. Position sizing matters. Small allocations only for development stage companies. By using this framework, you remove emotion and hype. You let structure guide decisions. That's how professionals operate. Gold and silver aren't being suppressed randomly. They're reacting to leverage, margin calls, and credit stress. Confiscation isn't coming in the old way. It's coming through taxation, regulation, and digital control. Private credit is the blind spot of this cycle. And when it breaks, capital will rush back to hard assets. Physical metals remain your foundation. Mining equities are your leverage. Knowledge is your edge. Stay diversified. Avoid concentration. Understand risk. And most importantly, don't let fear make decisions for you. If this helped clarify what's happening behind the scenes, share it with someone who needs to hear it. Stay sharp.